Hello and welcome. In this video, we will learn what OFS and FPO are. Alright? Now, before we do that, I want to tell you about the requirements for an IPO in India. Now, I have listed only three requirements here, but apart from these three, there are many other requirements too. Alright? These are all self-explanatory, but I will read them once. Alright? First, the company must have existed for at least 3 years. So, it should have existed for a minimum of 3 years. Second, it must have made profits in at least 2 years of its existence. Okay? Out of whatever years it has existed, it must have made profits in at least 2 years. Third, it must have a minimum net worth of rupees 3 crores. Alright? So these three are the main requirements for applying or for going for an IPO in India. But I have been conveniently using the example saying that before starting the company applies for an IPO. This is to make the example simple so that you will be able to understand it. Okay? But remember that there are requirements for going for an IPO in India. Okay? Now, coming to the topic of this video, I will take the same example that I have been taking till now. So first, we will learn about OFS. Okay? So let me quickly recap the story. Two friends want to start an industry which manufactures coconut oils. The friends who start the company are the promoters of the company, and let us say the name of the company or the industry is oil. To start the company, they know that they need 10,000 rupees. So person A has 4,000 rupees and gives to the company or contributes to the company. B has 2,000 and he too gives it. So totally they have 6,000. They need 10,000, and when you subtract it, you need 4,000 more to start the company. They go to the bank and the bank says we can offer maximum of 2,000 rupees at certain interest rate. So they take that too, and still they need 2,000 rupees, and so they split the company into 4,000 shares of 2 rupees each. Person A, who has contributed 4,000, and person B, who has contributed 2,000 rupees, keep 2,000 and 1,000 shares to themselves, and the rest is offered to the public through an IPO. The public buys the 1,000 shares in an IPO and they get their 2,000 rupees to start the industry. Okay? So this is what we have seen till now. Now, after some time, due to the profit, the value of share in the market is 6 rupees each. Okay? Now, this is not important to us. What is important is that the promoters decide to sell their shares at a discount. Okay? So after some time, the promoters who were holding 2,000 and 1,000 shares, person A and person B, they decide to sell their shares at a discount to the public. And when they do so, it is called as offer for sale. Okay? So person A or promoter A, I can say, promoter B have 2,000 and 1,000 shares, correct? If they offer the shares at a discount to the public, then it is called as offer for sale. Okay? Offer for sale. Now the question comes, why do the promoters want to sell their shares at a discount? Why can't they hold their shares and earn more profit? the company is doing good, correct? Why can't they hold it for themselves and then sell it at normal price and earn profit in the future? Okay, well, there are some reasons for this. First thing is, according to SEBI, okay, the governing body, promoters cannot hold more than 75% stake in a company. Okay, so if, for example, a promoter has, not a promoter, promoters have 80% stake in the company, then he has no other option than to sell the 5% shares through an offer for sale to comply with the rules of SEBI or government. Okay, so if they have more than 75% stake in a company, they have to sell it off. Okay, next, they may have their own reasons. For example, promoter A may want to invest money in something else, so he may sell his shares to the public and then use that money to invest it in some other asset. Okay, or he may be needing funds and so he may be selling the shares. Okay, now there is a red flag too. See, if a company is not doing good, then who will be the first person to know it? It is the promoter, correct? He has inside knowledge about the business and how the company is working. So if the company is in trouble, then these are the people who come to know about it before the public. So if a company is in trouble, they will offer their shares for sale at a discount price to get as much money as possible before the company goes down. Okay, before the company goes down. So that is a red flag, and this is what you have to watch out for. More about this later. Alright, so just know that offer for sale is nothing but promoters selling their stake or shares of the company. Okay, now next is FPO, follow on public offer. Now let us look at a story. Same story. 10,000 is needed, 4,000 given by A, 2,000 by B, 2,000 by bank, rest 2,000 is needed. 4,000 shares are created, out of which 3,000 is bought by or kept by A and B promoters. Rest 1,000 shares are offered to the public through an IPO and they buy that, and that is done. So over the next 5 years, the company is in profit. Profit is reinvested into the business after paying interest to the bank. The worth of the company is 24,000 plus 2,000 rupees loan from the bank, and the shares cost rupees 6 each. Okay, now this is the story that we have learnt before. Now the promoters want to expand their business further. Okay, they want to further expand their business. Maybe they want to export or they want to try out some different things. And to expand their business, they need money. Alright, they need money. And they have two options. One is to take loan from bank. Okay, one is to take loan from bank. But taking loan from bank has its own disadvantages. They need to keep on paying the interest, correct? They need to keep on paying the interest, and there is a limit for taking loan too. Alright, so leaving out this option, the other option that the promoters have is to offer new shares to the public. Okay, to offer new shares to the public. And when the public buys the shares, they get money and they can expand their business. Alright. Now, this is one thing. Other than this reason, maybe the promoters want to pay off the debt, or maybe the promoters want to pay off the loan or clear the loan. In this case, I have just given the example of 2000 rupees, but in reality, it will be thousands of crores. Okay, that will be taken by the bank. And the promoters, let us say, they want to clear that loan off. And to clear the loan, they need money. And to get the money, they offer new shares to the public. Okay, and this is called as follow on public offer. This is called as follow on public offer because this is not being done for the first time. IPO is already done. Okay, IPO is for the first time, initial public offering. It is for the first time. People have already bought from the IPO. It is already listed in the stock exchange. Now stocks are being traded in the stock exchange. Now if you want to offer, or now if the company wants to offer new shares to the public, it is called as follow on public offer. Alright, it is not initial, it is follow on. Alright, now there are two categories of FPOs. Let us see those. One is non-diluted FPO and the second is diluted FPO. So let us try to understand what these two are. First is non-diluted FPO. So you know that promoter A has 2000 shares, promoter B has 1000 shares and public has 1000 shares. If the promoters, any of the promoter sells his own shares to the public, then it is called as non-diluted FPO. Okay. For example, he had 2000 shares. If he decides to sell 1000 shares to the public, then the public will be having 2000 shares. He will be having 1000 shares and this promoter will be having 1000 shares. Okay. So the total number of the shares will be same before and after the IPO. So before IPO it was 2000, 1000, 1000, 4000. So after, not IPO, sorry, it is FPO. After the FPO, it is 1000 plus 2000 plus 1000. It is 4000. Okay, it is 4000. So the total number of shares before and after the FPO will be same in non-diluted FPO. Okay. Now, you may have a doubt. If the promoters are selling it to the public, how can the company generate money? Correct? Basically, you are selling the shares, or the promoters are selling the shares to the public. So whatever was here now is here. That's all. How does the company get money? Well, the company doesn't get money in this case. It is just that the public stakeholding will be increased. Okay, public participation will be more in the company. That's all. All right. So if they want to generate money, they have to go for diluted FPO. Okay, diluted FPO. So here promoter A has 2000, B has 1000 and public has 1000 shares. So promoters in this case will not be selling their shares, but the company will create new shares and offer it to the public. So let us say the company creates 1000 new shares and offers it to the public. So the public buys it. So now the public has 2000 shares, promoters have 2000 plus 1000 shares. So here we have 2000 plus 2000 plus 1000 shares. It is 5000 shares. Okay, 5000 shares. Alright. So the number of shares after the FPO will be more than before in the case of diluted FPO. And if the company wants to generate money, it has to go for diluted FPO. Okay. Now, why does a company offer its FPO? Okay. Why does a company offer its FPO? As I mentioned, if they want to expand their business or if they want to pay off their loan, they offer their FPO. Okay, FPO. All right. Now, you as an investor, how does the FPO affect you? Okay, how does an FPO affect you as an investor? Now, just think about this. Compare IPO and FPO. What is IPO? Initial public offering. When does company normally offer an IPO? Before starting company. Correct? So before starting a company, you as an investor will not be knowing how the company will perform after it starts its operation. Correct? So you will be taking a risk there in an IPO. Whereas here in the case of FPO, you already know how the company is working, how the business is running, whether it is doing good or whether it is doing bad. So there is less risk involved in FPO compared with IPO. Okay? Now, FPO price will be generally lower than the market price. Market price means the price at which the shares are being traded at. Okay? So when the company offers an FPO, then it will be offered at a lower rate. This is done to attract the investors. Alright? Now what does the company want? It wants money. And how do they get money? By selling shares. So the company wants investors to buy their shares in an FPO. Okay? And so they offer it at lower price than market price to attract the investors. Alright? Now, if there is an FPO, you as a retail investor, common man, should you buy the shares or not? How do you decide it? Now you can decide it by answering 3 questions. So let us see those 3 questions with our coconut oil mill example. Okay? So should you apply for the FPO? The first question is, why is the company going for an FPO? What is it that the company wants to do? Does it want to expand the current business or does it want to go into a new business? That is the question that you need to answer. For example, if you take coconut oil mill, why does this company go for an FPO? Is it to increase the production of coconut oil itself, or is it to do something else? If it is going to increase the capacity of production of coconut oil, then it is well and good, because currently the coconut oil is being sold and there is a demand and there is a market, which is very good. So if they want to produce more of coconut oil, then you know that the company will be doing good. Whereas if the mill wants to do something else, let us take for example, if they want to make olive oil, then it will be risky for the investor, because we do not know whether olive oil will sell in the market just like coconut oil. Or, in other words, let us say that they expand their business and start producing olive oil. We do not know whether it will be profitable in long run. We do not know whether there is a market for olive oil. Okay, so we do not know what is going to happen with the company. So whether they are doing the same thing, expanding their business, or they are venturing into a different area. That is the question that you need to ask. If they are expanding their current business, then it is good sign. If they are doing something else, let us say, then it is not a good sign. Well, it may be a good sign, it may do well, olive oil may sell well, but before investing, we will not be knowing how it will be in the future. Okay, so that is the first question you need to answer. Second is, what is the promoter shareholding? How much shares are the promoters holding? Now, I talked about offer for sale, correct? Now, FPO. In the FPO, are the promoters buying the shares? If yes, then it is good, because promoters are confident that the new venture will be successful, and so promoters are also buying from the FPO. Whereas if you see an OFS in FPO, okay, so in the FPO, if you see offer for sale, that is, if promoters are trying to sell their own shares in an FPO, then it is a bad sign. Okay, why do the promoters want to sell their own shares in an FPO? What is it they are hiding? Correct? So that is a bad sign. So if the promoter shareholding increases or it stays the same, then it is good. But if they are trying to sell their own shares in an FPO, then it is bad. Okay. Next, how much is the debt? Debt is nothing but loan. Okay. How much is the debt? Do they have lot of loan which needs to be repaid, or are they clearing the loan yearly? If they have lots of loan, then it is a bad sign. If they have cleared and it is only a small amount, then it is good. Okay. So if you answer these three questions and you get the answer positively, then you can go for the FPO. Okay. Now these are basic guidelines. Okay. These are basic guidelines. These are no strict rules for applying for the FPO. Alright. So think well, study about the company, and then decide whether to go for the FPO or not, or buy the shares from FPO or not. Alright. Yes. So that was the topic for today. I hope you have understood. I'll see you in the next video. Till then, take care and thank you for watching.